Hello, Jon Williams with Manulife Securities and Williams Financial Group. Today I'm going to provide you with a recap of the significant market events for the quarter and year ending October 31st, 2015. As we say goodbye to 2015, we can characterize it as a year where the equity market returns were disappointing. Excluding currency, it was a sideways year marked by volatility that was not limited to just one area of the world or individual market. It truly was a team effort that drove markets up, down, and for the most part sideways. Starting at home, Canada faced a number of challenges that included a precipitous drop in oil prices extending from losses from 2014, a recession, and an election resulting in a new government. The price of crude oil continued to fall during the year, with only a brief reprieve in the summer before hitting new lows in December. The pleasure at the gas pumps that Canadians benefited from translated into pain for energy stocks as the benchmark West Texas Intermediate price per barrel of oil started the year at $60.50 and subsequently fell to $37.50. As we've mentioned in the past, oil's problems are global. Global oil production continues to be above global demand, resulting in a significant supply glut. On one hand, oil's drop has made it more pleasurable or less painful for us to fill up our gas tanks today as opposed to a year ago. On the other hand, it makes being a Canadian equity investor that much more challenging, as 25%, a quarter of the benchmark TSX Composite Index, is comprised of energy companies. Further, it doesn't appear that supply is going to be abating anytime soon. Stubbornly, OPEC producers have dug their heels into the ground and are maintaining elevated production levels. Canadian oil companies have announced billions of dollars in labor and production cuts throughout the year as a result. Looking ahead through 2006, a drop in supply should push oil prices higher, but when that drop will come is unknown. As oil prices fell, so too did the Canadian economy, dipping into a recession the first half of the year. In response, the Bank of Canada Governor, Stephen Poloz, cut the overnight lending rate twice in 2015, first in January and then again in July. This provided support to the stagnating economy. Additionally, the Canadian dollar, which has reverted back to its petrodollar status, fell 16.2% on the year relative to the US dollar. Further, Canadian stocks, as measured by the TSX S&P Composite Index, fell a full 11.9% through the year, led downward by the energy sector, which was down minus 22.9%. South of the border, the U.S. equity markets fared slightly better, losing 0.7% as measured by the S&P 500 index. Throughout much of the year, the U.S. equity markets was driven around speculation on what the Federal Reserve might or might not do. Ultimately, the Fed chose to raise their benchmark interest rate by 0.25% in December, the first rate increase since 2006. Looking ahead, 2016 will be a year dominated by election talk. Come November, the U.S. populace is guaranteed to have elected a new president. Leading up to Election Day, equity markets will most certainly be paying attention. Globally, Greece and China made the headlines throughout the year. Putting Greece aside, as it already has had more than enough attention, China is now the real focus. The world's second largest economy has contributed significantly to the amount of volatility, and it's because it's showing signs of an economic slowdown. Global stocks, as measured by the MSCI World Index, fell minus 0.3% in US dollar terms. The interest rate environment witnessed its own excitement throughout the year, with the Bank of Canada cutting the key overnight lending rate twice, the European Central Bank initiating its own quantitative easing program, and the Federal Reserve raising interest rates. By the end of the year, Canadian bonds did perform better than Canadian equities, and when excluding currency, better than foreign equities. Bonds, as measured by the FTSE TMX Canadian Universal Bond Index, gained 3.5%. The volatility of the past year is a good example of the benefits of a diversified strategy. Markets are unpredictable. This goes for bonds as well as equities. Other factors that pay into returns, currency, interest rates, are equally as unpredictable. A balance between many asset classes, that is Canadian equities, US foreign equities, bonds and cash, will help mitigate the volatility while working towards achieving our clients' financial objectives. As we move into 2016, we must consider that the markets will remain volatile. Certainly, if the start of the year is any indication, China, the global economy, oil, the weather, and any other unforeseen issues will continue to move markets in different directions. A cautious and well-balanced portfolio approach should serve us well in the coming year. Finally, as you're reviewing your New Year's resolutions, it's a good time for us to review your financial goals and asset allocation to assure that they line up. As always, if you have any questions about the markets or your investments, we're here for you.